Hello, everyone, and welcome to this special webinar today from CryptoTaxPrep.com. Today, we're going to talk about crypto tax reform planning. We are glad that you are with us. Mario Costanz, our CEO and founder, and I am Knox Wimberly, the tax director here at CryptoTaxPrep.com. We're so pleased that you are with us today. We know that you are going to learn a lot. This is for cryptocurrency traders. So if you are a crypto trader, then this is designed specifically for you. For people who have exposure to crypto activity, and maybe your current tax practitioner doesn't have the expertise to really guide you and help you through this process. We're glad that you are with us today, and we hope to earn your business as a future client. With that, I am going to turn it over to Mario, who is going to talk a little bit about our first strategy.
Great. Thank you, Knox. Appreciate that. And welcome, everyone, once again to our webinar here tonight. So we're going to be giving some great free content to you, try to show our expertise to you, and with the confident knowledge that most likely your existing tax practitioner is not providing you with this. And as Knox mentioned, to hopefully earn your business. So first, we're going to talk about tax loss harvesting, and that's also known as a wash sale. Let's start with wash sales and talk about what they are. So it started out with stocks and bonds, people that own them as securities, as investments, and they, for some time, people would say, hey, I've got this stock, and I'm just going to use an example, and I bought it at $100. And now the stock is down to $50. So the way capital gains work, you either have a gain or a loss. And then that impacts all of your trades. And then that influences how much taxes you have to pay based on the aggregate amount of all your combined capital gains and losses. So many years ago, some smart people said, hey, I got this stock and I bought it at 100 and it's now down to 50. I still believe in this stock. I think it's going to come back. I think I'll make my money. But what I'm going to do is I'm going to sell that stock for $50. And when I do that, I've locked in a capital loss of $50. So that $50 times however many shares, and in many cases, depending on how many you own, that could be significant, will become a loss that will do one of two things. It will either offset any and all other gains that you have in that tax year. So that, let's say you were winning on some trades and building up lots of profits that you would have to pay taxes on at the end of the year, and you made this trade to lock in that loss, but with the full intent and knowing that you're just going to rebuy that same stock and then ride that out. So the IRS caught wind of that because people were reducing the amount of taxes that they would have to pay by taking use of this. And they said, hey, you can't do this no more. So they passed some regulations, and it's called a wash sale. And in the regulations, it states very specifically that when you're trading securities, meaning stocks, bonds, or mutual funds, you cannot do a wash sale for purposes of locking in that loss and offsetting your other gains. The other thing that it could do is if you didn't have any other gains for that year and you locked in that loss and then just rebought the same stock, you could actually create a deduction that goes against your overall other income outside of your trading activity. So they made a rule, and they said you cannot do this for securities purposes within 30 days. So for instance, if you bought a stock and it was down and you sold it, you can rebuy it. They don't prohibit you from rebuying it. You can rebuy it 2 seconds later or 2 days later or whenever you feel like it. However, you cannot use that loss if you rebuy that same stock within 30 days. If you sold it and you locked in that loss and you rebought that stock 31 days later, you can, and it would not be a wash sale, but it kind of negates the benefit because who knows if that'll go back up or if it will continually to go down. And so this is something that many traders were using algorithms to create these losses, and yet they were still at the same time holding the same positions. Now, here's the awesome thing. When they wrote that regulation, they wrote that regulation very specifically and used the word securities. Now, the IRS at the same time in 2014 has deemed that cryptocurrency is property for purposes of taxation. Hence, currently, cryptocurrency does not apply to the wash sale rules. So now let's take that scenario and let's talk it through on how you can use it for cryptocurrency trading purposes, especially in the down market that we're in now. So let's say that you've been got involved in crypto in 2017 as this example, and maybe mid-year you started buying some positions and they went up and you sold them and you had some nice gains there, and hopefully you've included those in your tax return because it is required. Misconceptions out there like that we've heard a lot of, that people think that coin-to-coin trades are not taxable. They are. Like-kind exchanges are allowable. They are not. So anytime you're doing any type of trading activity, you need to have claimed those trades on your tax return. If you haven't, we can help you to get into compliance and stay out of hot water with the authorities. Now that said, let's go back to our example. And you made some money in crypto in 2017, and then let's say you bought some more. You kind of reinvested it, and you were moving your coin around, and you unfortunately bought some Bitcoin in December. And let's say you bought it at $19,000. Clearly, we know now that Bitcoin is currently about $6,000. So that's a $13,000 swing on any Bitcoins that you bought. Clearly, you may have portions of those Bitcoins, or you may have many Bitcoins, depending on the size of investor that you are. But this is how you can utilize that strategy. So you have established your cost basis on any positions when you buy them. And let's use, for example, some Bitcoin you might have bought in December of 2017. Let's just use in this example that you bought one Bitcoin. And that one Bitcoin clearly has lost $13,000. If you went today, tomorrow, when you feel like it, and sell that Bitcoin, you will have a $13,000 tax loss. You can rebuy that Bitcoin right away if you are a believer in that particular coin and a believer in cryptocurrency, which we are here at Happy Tax. We're crypto enthusiasts, investors ourselves. And now, in that example, you've got a $13,000 loss, or maybe even much more if this is applied to owning many Bitcoins or many other types of coins that you might have had larger positions in, or even if you had smaller positions, this still works. Then what happens is any other gains that you had this year thus far, or that you will have for the rest of the year, you would not pay taxes on the first $13,000 of that. That loss is locked in to offset any other gains that you're having. Now, you can do that across all coins, not just Bitcoins, and you can, most or many coins have been down since December of 2017. And there's also, as you know, as a crypto trader, a lot of volatility and a lot of fluctuation. There could also be things that you bought before then. Even if you bought it before 2017 and it's now in a down position, any of your positions that are down, this can apply to. So what will happen is you sell it, you rebuy it, you lock in the loss, and you can look across your portfolio, find which positions you have, and a couple things can happen. Now, let's say that you haven't traded anything this year. You said, you know what, I'm a holder. I'm just holding on to what I got, and I want to keep the investments that I've had in crypto in the same coins that I have. So let's just say that you had no other sales for the year. And let's just say that's the only trade that you make for the year. So now you've got a $13,000 loss. And let's say you have a job and you're making $100,000 a year. This $13,000 gets to get deducted from your adjusted gross income, but not the entire $13,000. Here's another trick and a rule, or not so much a trick because it doesn't necessarily help you in its entirety yet. So only up to $3,000 in overall capital losses can be deducted from your adjusted gross income on a yearly basis. So in this scenario, this year you'd be able to deduct $3,000, and then the remaining $10,000 would flow to next year, and you'd have another $10,000. Now that $10,000 goes to the starting point of being able to offset any other gains. So let's say next year you did make some trades and you made some money trading crypto or other capital assets for that matter. And let's just use this secondary piece of the example and say next year you carried that $10,000 loss over and you made $20,000 next year. Well, what's going to happen is this $10,000 will be reduced from the $20,000, and instead of having to pay taxes on $20,000, you'd only pay it on $10,000. Cool stuff, right? Or if you didn't have any gains, or you didn't have a full $3,000 in gains, the additional money would flow to the following year. So you'd be able to continue to liquidate that tax loss until which time you either had some additional gains or you've soaked up the $3,000 per year until it's all gone. And what does this mean for you? So, you've got capital gains rates that range from 0 to 38.6%. So depending on the tax bracket you're in, depending on if it's long or short-term gains, you could be getting back up to almost 40%, 40 cents on the dollar of these losses that you generate. So it is very lucrative to utilize, and it is something that most people don't know about, and it's something that most people kind of write off, even if they did know about it, because they say, hey, the wash sale rules probably apply. Well, our research team of CPAs and IRS enrolled agents has dug in deep to the tax code and figured this stuff out, and we're here to offer this to you as a way for you to have tax minimization. There are also some other tax minimization strategies that we're going to talk about here today. I'm going to turn it over to Knox in a moment, but I will also say that we use here at Crypto Tax Prep an algorithm that will enable you more tax minimization than you will ever find anywhere else. We've actually saved our clients over $20 million in taxes in the last couple of months alone. So there's not only these strategies that we're teaching you here, we use an accounting method that minimizes taxes by picking specific tax lots that have the best or the lowest gain, and then also cross-references that against the long-term and short-term rate. So we run this algorithm on everyone's trades after we do the work of reconciling your data, doing your accounting, and then doing your tax prep. So we're going to talk to you right now about another great tax planning strategy that you can utilize. And with that, I'm going to turn it over to Knox.
Thank you, Mario. And we actually had a question that came in about tax loss harvesting and wash sales, and so I want to address that. The question was that I use coin tracking, and the system is programmed so that tax losses are not generated unless you follow the wash sale 30-day rule. Is there disagreement on Happy Tax's interpretation that the wash sale rule does not apply? And then he indicated that he did some testing of the system with mock trades and determined that this is what their system is doing. So let me respond to that briefly and just tell you that, there are multiple tools out there. We actually utilize coin tracking info some ourselves. We are partners with them. If you go to their website, you will find that we are listed as a recommended source to go. And so we have done lots of business together. I believe it's fairly safe to say that we are their largest corporate client. We're everybody's largest corporate client because we do more of these returns than anybody, and we have used all of the reputable tools in the system. So we utilize different tools for different clients depending on your particular needs, and we have some proprietary stuff, just like Mario just mentioned, that we utilize as well. Having said that, Coin Tracking Info is a service that works in multiple countries, so it is not exclusively US based. And in fact, it's not based in the US at all. They're out of Europe. And so they don't necessarily know all of our tax laws, and they don't claim to know all of our tax laws. But I can assure you that wash sales are, as Mario mentioned, specifically written into the tax code, specifically written into the law that Congress passed and was signed by the president years ago when the wash sale rule was created. So this is not even an IRS interpretation. This is specifically hard-coded into the law, and it would literally take either an act of Congress to change it, or the IRS would have to change their interpretation of what cryptocurrency is. And the only guidance that we currently have is actually from an IRS notice in 2014. If you want to look it up, it's IRS notice 2014-21. You can Google that really easily and go see it. And it specifically states right in the very first point that cryptocurrency is to be treated as property. Now, in that particular notice, they call it virtual currency, but the two are synonymous. So it says that virtual currency is treated as property. Because of that, it is excluded from the wash sale rule. Now, has everybody figured that out? Of course, the answer to that is no, but that is the reality. And I will tell you that Mario and I actually both serve on some tax industry working groups working on the taxation of cryptocurrency and working with the IRS to help them mold and provide their next guidance. So like I said, we do more of these returns than anybody. We really are the experts in this, and we are very confident in what we are telling you today. If you have any other questions about that, then certainly feel free to ask a follow-up question, or we could even talk some offline as well. So just wanted to sort of answer that one before we move on, since it was related to what we just talked about. The next thing that we're going to look at is creating additional deductibility using mining. So most of us know what mining is, I'm guessing, if you're in the crypto world, but this is a process that utilizes resources on your computer, or you can get into a cloud pool and do some cloud mining where you're actually utilizing together with others resources that are outside of your home or outside of your business. But a mining operation is, the IRS says, in that same notice, by the way, the IRS notice 2014-21, considered to be income producing, and as such is likely to be treated as a business. Now, because it is to be treated as a business, that means that there are also deductions that can happen for your expenses. And it is not unusual for a business in its first couple of years to lose money. In fact, it's perfectly normal for a business to lose money for its first few years. Most businesses lose money for their first few years. It's a rare exception for a business not to lose money in its first few years. And so mining, the IRS says, is probably a business. It is income producing. And so if you created some mining operations, some mining rigs, and you had some expenses in order to do that, and you had some electricity that was being used specifically related to these mining rigs, you had some graphic card purchases, some other hardware purchases perhaps related to this mining, maybe even some education to learn how to do it. These are business expenses and can create additional deductibility. And so this is another fantastic way that you can offset potentially some gains that you may have. And it looks like we have another question or two. And actually, I am going to ask this one and let Mario answer it, because it goes back to what he was talking about earlier. And that is, do you use FIFO or LIFO or some combination thereof? That's the question, Mario.
So what we do for our clients is we look at the allowable accounting methods that are available and allowable. And we check each client which works best for them in which scenario. Now, oftentimes, it's neither FIFO or LIFO, but it is the proprietary tax lot specification of picking the specific tax lots that have the least tax liability associated with them. And again, that could vary because sometimes that boils down to if something is long-term or short-term, and sometimes that boils down to on how big the gain was. So sometimes you can have something that had actually a larger gain if you pick one specific tax lot, but it becomes a long-term instead of a short-term, which brings some serious advantages to the lower tax rate there. So we, with our clients, don't just say, hey, we do FIFO, we do LIFO, we do tax lot specification. We look at all scenarios for our clients to make sure that we're getting them the best possible outcome. We have a full team of cryptocurrency bookkeepers and accountants that work on that prior to even getting it into our tax department and finalized by our CPAs. So this is a process that we go through for each and every client, and we're really proud of that $20 million that we saved for our clients using these various methods, but it is not one size fits all. We do what's in the best interest of the client and make sure that they have the least possible tax liability or biggest refund. If you are someone that's getting a refund, then this is impacting how much refund you get, depending on how much trade you are. And I will mention too that if you haven't included your crypto for your prior year returns, you should. The wave is coming. The IRS does have the data from Coinbase. It was turned over to them in March. They are working on sending out letters to taxpayers that have not included it or haven't fully included it. That's going to include penalties and interest. By amending and getting that sent in prior to that, there will be significant penalty abatement and reduction opportunities instead of waiting to get caught. There's no value in waiting for the IRS to catch you. And combined with the KYC data from Coinbase and other exchanges that they're working on and with to get, there's no anonymity when you match KYC data with wallet addresses. It's a public ledger. It's the easiest audit the IRS will ever make. It's akin to working at a job, getting a W-2 and just saying, hey, I'm going to leave that W-2 out of my tax return. You get caught every time. And the same thing will happen to those that decide not to include their cryptocurrency trades or gains inside of their return. The IRS is working on their systems and processes to easily send out these notices. They send out millions of similar type notices now every year for other people that leave other types of income out. And once they finish connecting the dots here, they'll be doing that here as well. Thank you so much for that question.
Yes, and I am going to now talk some about requirements when we use foreign exchanges. And I know that this slide is a little bit hard to read, but this is important to understand because we have discovered that if you're not using preparers that specialize in the taxation of cryptocurrency, many of them are missing these requirements. And you're going to understand in a minute why that's a big deal. So there are two laws that obviously were passed by Congress historically that impact this, we think, or possibly do. I'm going to talk about both, and then I'm going to talk about the way we treat both here at CryptoTaxPrep.com and Happy Tax. So the first one I want to talk about is what most people call FBAR. Now, that's really a report of foreign bank and financial accounts. Who wants to say all that, right? So we just call it FBAR. The actual form that you file is the FinCEN 114. Now, interestingly enough, this is a separate tax return. So it is not, or it's actually an information return. It's not a tax return. But this is not something that gets filed with the IRS. It is filed with the Department of, or with the Department of Treasury. It's actually filed with the Financial Crimes Enforcement Network and BSA. And so that is who it is filed with, which is another part of the Department of Treasury. other than the IRS. It is not included in your regular income tax return. So if you're an individual, that would be a 1040. This particular requirement says that if you have $10,000 aggregated in US dollar equivalent at any point during the year in a foreign account, then you must file an FBAR. And so if you have 10,000 or more aggregated, so I can have 5,000 on one, 3,000 on another, and 3,000 on another exchange, if they're in foreign, that aggregates together to be 10. Well, actually, it aggregates to be 11 in that case, but it aggregates to be 10 or more. And so that is going to have an FBAR requirement potentially. Here's why I say potentially. We have not received guidance from the IRS or the Department of Treasury as to whether or not cryptocurrency exchanges meet these requirements. Now, here's the good news about the FBAR. There is no tax related with filing the FBAR. As I mentioned earlier, it is simply an information return. All we're doing is reporting to the Department of Treasury that, hey, we have these foreign amounts out there. And the whole reason they're getting this is for anti-money laundering. They want to fight against money laundering. So there's no tax related with reporting this. There's no downside other than obviously you're going to pay a preparer to prepare it. It's only $150 if you do it with us. So that's not that big of a deal compared to the potential penalties. So let's talk about the potential penalties. If you do not file the FBAR, it is a penalty of at least $10,000, and that penalty can be up to $100,000 or 50% in the amount of the accounts at the time of the violation. Now that is huge. So here's the options. If they determine it applies and I filed it, it didn't cost me anything other than a small amount to prepare that return. If I did not file it, I'm going to have penalties of at least $10,000 and maybe significantly more if the IRS decides that it was a willful failure to file. That's a big deal. So for us, we certainly advise all of our clients to file the FinCEN 114 if you meet those threshold requirements. There's another law that's also relevant here, and that's the Foreign Account Tax Compliance Act, or the FATCA. And actually, we have that misspelled on the slide. We had a typo, so sorry about that. It's FATCA, but it's the Foreign Account Tax Compliance Act. And this is filed with the 1040, filed with your IRS tax return. It goes on a Form 8938. You don't have to worry about that. We take care of that for you. Here's the threshold requirements for this one. If you have, and you're a single person or married, filing separate, and you have $50,000 or more at the end of the year, meaning 12/31 in US dollar equivalent, again, aggregated, or $75,000 at any point during the year. Again, that's for single or married filing separate, actually, or head of household. If you are married filing joint or qualifying widower as your filing status, then it's double that. So 150 and 100 would be the limits there. If you meet these requirements, and this one we do for 150 as well, by the way, but if you meet these requirements, the penalties on this are even greater. $50,000 for not filing these. And again, if they decide it's willful, it can be a percentage of the amounts that you had. Now, on this one, I am reasonably confident they're going to determine that it is required. And that is because this one is related, the way that the law is written, to foreign assets. So I'm pretty confident that cryptocurrency would be considered an asset. In fact, I have 90% confidence in that. And so I'm very confident that you really need to file the FATCA. And again, there's no tax related with doing that. It is simply informational in nature. So I wanted to point that out to you, because if you use someone other than us, for example, last year, or you tried to do it on your own and you didn't include these things, the penalties are huge, and you're going to want to fix that. And you certainly want to use someone that knows about these things. And with that, I'm going to turn it back over to Mario, who's going to give us some more reasons why you really want to make sure you have someone who knows what they're doing assisting you in this space.
Great. Thank you, Knox. So what we'll talk about now to close out our presentation is why would you want to use a professional? So, many people do their own tax returns. In fact, about 40% of all people self-file. That number's been pretty consistent for the last 30 years or so. And with using a professional, specifically a professional that knows cryptocurrency inside and out and has significant amount of experience doing so, you're going to get professional guidance. Do you really want to go and learn 70,000 pages of tax code? It's not your specialty. It's not your expertise. It's ours. So it's always better to let a professional do what they're trained at doing and enable you to focus on your life and on your business and on your trading in this context, along with our tax guidance, which can actually help make your trading more profitable by lowering your overall tax rate as represented in some of the items that we talked about here and the guidance that you get on an ongoing basis in working with us. Every situation is unique. So as I mentioned in the accounting methods question, there are people that have many other scenarios that are able to be narrowed down into tax strategies that will save them money, and chances are you don't know about that. We do this for a living. We do this on a daily basis. We've got over 100 CPAs, accountants, and preparers that work for us, making sure that everything is done right. We also have in our package, some of our competitors do, many of them charge extra for it, and some of them don't offer this at all. In fact, some of them charge for this if it happens. But if you ever were audited, we have free audit assistance included with our packages. So if you get a letter, we're going to help work through that with the IRS for you and help you handle that as well. And we're there for you when you need them. So we've got clients that might have some questions, have some tax planning advice needed. Reach out to us. We'll get you the information and make sure that you're kind of looking at your trades on a profitability basis, as it also includes your taxes, because you can't think of it only based on the trades. We help many of our clients to pay estimated taxes. For those that, believe it or not, there are still some people making money in crypto even now with how the downturn has been this year so far. And if you are, and when you are making money, you really need to kind of allocate for taxes and submit those payments in quarterly to avoid any penalties for not fully paying. Tell you a little bit about the service that we have here at Crypto Tax Prep. We are 100% US-based licensed CPAs preparing the actual tax returns. In addition to that, the reconciliation, bookkeeping, and accounting is all included, helping you gather that data from all the various exchanges and wallets, reconcile it, which oftentimes has missing cost bases when you move crypto from one wallet or exchange to another. In fact, Coinbase has even admitted that their reports are wrong, and many of the reports, if used by and of themselves, are wrong. Our team knows how to look out for that, how to handle that, and how to fill in the blanks that will help to minimize your taxes. Accuracy is guaranteed, so if we ever made a mistake, we'll pay any penalties and interest. We would refund the cost of the return, and we would amend it for free as well. That's how confident we are to stand behind our work. We don't charge anything extra for that. That's included in our base prices. And as I mentioned previously, you get 100% free audit assistance with us as well, should that happen. That happens under 1% of the time, so you don't have to be worrying about that, especially if you're being proactive and being compliant and including everything. We also get year-round support. We don't go anywhere. Many tax providers, they work during tax season and they either do something else the rest of the year or they disappear back to another country or go on vacation. We love this business. This is our livelihood. We've got a great group of people working with us, and we're here for you year-round for support. We've also got an affiliate program for any of you that have followings in the cryptocurrency space. You can sign up right on our site for that affiliate program, and you can share any revenues for helping us to get the word out about us and our service. Finally, you would think that why would I even bother thinking about signing up with Crypto Tax Prep now? It's not necessarily tax season. And there's a couple of reasons why. First of all, you get access to our team now. You don't have to, you can have that tax planning in place between now and the end of the year that's going to help you maximize your situation moving forward. That one-on-one tax planning advice is available in our plans. You can take a look at them on our site. And we are also about to have a price increase. So Friday at 8 p.m., we're going to increase our prices. The price that we had for last year, we found that they were a little low for the type of service that we were providing and the amount of help that we have to invest in helping people to get all their trades ready in that reconciliation process. So this is kind of a last chance to get in on last year's pricing. So that pricing will be updated tomorrow night. And we're going to offer a discount to this year's pricing. If you use this particular coupon code and you sign up before then, you can lock in 25% off last year's price with coupon code USA25. So you would just go to cryptotaxprep.com, take a look around the site. You'll see very clearly all of our plans, and you can sign up right online. And the process from there is our team would reach out to you, start to gather your information and get you set up onto our system so that we can pull down all of your trade data from APIs or CSVs. We never ask for any private keys or anything like that. We're very security conscious and help you to get all that stuff ready so that you don't have to scramble during tax season. You don't have to worry about a tax provider saying, hey, I don't know how to do this part. You don't have to worry about getting hit with penalties and interest by not including it. So keep in mind that this includes that entire process. All of our prices include the reconciliation, the accounting, the bookkeeping, and the tax return, your full tax return of not only your crypto portion, but also any of your other income is all included in our packages. We're an all-inclusive service. Although we do work with some people that just want us to do the reconciliation, and that's fine. If you still want to bring your return and have your return done by your existing tax professional, we certainly understand and respect that. We don't necessarily always advise it because there are also sometimes some intricacies there where you could be leaving some money on the table, but at the same time, we do respect that choice. With that, if you have any questions, you can always email them to myself or Knox. My email address is mario@happytax.com, and you can reach Knox at knox@happytax.com. And to sign up, you can go to cryptotaxprep.com. And with that, we want to thank you for your time here and have a wonderful day. And we look forward to talking to you soon. Take care now.